Greetings, everyone. This is Ambuja. I'm here to represent our group for the group assignment on the RIT decision cases. So I'll be starting off this presentation. So let's start from the part one, which is the Thor algorithmic trading case, as well as the passive market maker case. So let's actually go into the Thor case and the objectives and the strategic path behind it. So in this case, the Thor Smart Order Router was a basic price ticker that used to unwind tender positions with market orders across market M and market A, and now it's getting reworked into a passive marker. So, passive maker rather. And what this means is under the baseline, normally every share pays a bid-ask spread plus a take fee of 1 cent on the main exchange and half a cent on the alternative exchange. However, our path actually posts limit orders at the best bid and ask, so we actually earn the spread instead of paying it and provide liquidity rather than consuming it. So this algorithm is also special because it shadows and cancels the quotes every 200 milliseconds, and it doesn't allow any order to go stale. And the algorithm only trades when it is unwinding a tender, and it doesn't speculate, which helps us avoid fines as well. Let's actually go into how the algorithm works and the logic behind it. So the function only runs when the simulation is live. That means the time is remaining between 1 and 300 seconds, and also the algo switch is on in the Excel. So each cycle actually begins by canceling all existing orders on both market M and market A. So no quote rests longer than 200 milliseconds. This means that the order is always at the top, and the position actually that we need to execute comes from get ticker info, which has smaller child functions giving us what volume is actually trading. So it's normally either the outstanding position or the algo volume limit of 25,000 shares. So if we are long, we post a sell at the lower of two ask prices between market M and market A, and if we are short, we buy the higher of the two bids. So the routing of the transaction actually follows the notional best bid offer, and the best price wins. And on a tie, we actually go to the venue with more depth or fill probability, and if the depth is equal, we choose the alternative market for its quarter cent net rebate as well. And also the testing has shown prioritizing the fill rate, better fill rate rather than the rebate has actually produced better results. So finally, the order is submitted as a limit order and not a market order. And then after the orders are filled, after each transaction, we cool down and loop back to the start. Let's go into the strategic rationale and limitations of this case. So why passive making actually beats the baseline is because it posts limit orders. We avoid both the spread and the take fees of the smart order routing case, and because it pays that, but as a maker we earn the alternative venues net rebate, and this helps us lift profitability. Now, crucially, the algorithm only trades to unwind tender positions. It does not chase arbitrage or anything that looks like front trading or speculation, so it avoids most fines. And also, order shadowing keeps every quote at the current best price, helping us get the best price across both markets. Now, there is a limitation because because of the order shadowing, we're canceling every so often and the order fills slowly. And if a position is open at the end, we are fined. However, since the person actually has the judgment to accept the tender or not, I think the person will choose rationally. Now let's go into the code structure and how it is organized. The passive marker function is our work, and the main body, the cancel and repost cycle, as well as the passive price selection and the venue routing logic. So these functions actually replace the template smart order routing position and the closing block. So everything other than that, basically the RTD links, the template, everything is we were using the previous smart order routing, and we've tried not to make too much unnecessary changes to it just because of certain limitations, as well as we are trying to check whether our strategy actually works or not. And If it does work, our without changing too much of the architecture, we can actually test it in the market, and that helps us unwind our position and actually get a good read on what's actually going on. Looking at one of the trading summary snippet, we can see the passive market maker actually had a profit here, and that is because of the good fill rate. Although it was canceling every 200 seconds, it managed to fill the order, and that resulted in a positive position with a good spread rate as well as some rebates from alternative markets. Now, I'd like to pass it on to Imon to go through the Thor analysis as well as the discussion question.
So I'm going to present about performance analysis. To start with performance analysis, I want to explain about slippage. Slippage occur due to the market volatility, especially in the case of market order and especially for the large order side. In this case, for the baseline SOR, I assume target selling price VWAB selling price, which is volume weighted average selling price, and this is 9.705 in the slide. And for executed price, I assume prevailing market price before market closure in the graph, which is 9.55. So we can understand that slippage as 0.94205 in this case. In this simulation, profit amount over 60,000 has been gained, and this is mainly corresponded of tender winning with very favorable price. So, so about transaction cost, we are going to move to transaction cost analytic. So transaction cost is calculated by the unfavorable spread, and then transaction cost and then added by the exchange takeoff fee. So this is more related to the market order position, but in contrast to the market order condition, for limit order, it provides liquidity to the market, commission and rebate coefficient. However, there are opportunity costs, and we will move to the topic of profitability per share, which is calculated by dividing to the profit by to the trading volume. In this scenario, market order gain more profit. So I want to discuss the so we'll move to the topic of profit. I will move to the discussion question, which is about relationship between breadth and depth of the book and the evaluation. So based on that, we will evaluate the institutional order. So we careful analysis of the breadth and depth of the limit order book actually can enhance the overall profitability across the trading process. So depth analysis can give insight into the smaller passive limit order, while breadth analysis could give an idea of how fast trader can execute the trade and market resilience. So that's all for me. Thank you.
Now let's move to case two, which is portfolio insurance using European style options. Our starting position was 100,000 shares of Pogo, bought at $20 a share. The mandate here was very specific: manage downside risk and not generate profit, and do it cost effectively. Importantly, we weren't allowed to trade the stock itself. All hedging had to go through European style put and call options, cash settled monthly. Annualized volatility on Pogo was 30%, and we had a 3-month window, which was January through March, to build and maintain the hedge. To choose our strikes, we used the square root of time rule. For the monthly protective put, that gave us 8.66% volatility. So the strike was set at spot minus the 8.66%. For the quarterly collar, since it covered a full 3 months, we used 15% volatility instead. Each month we only had 3-minute execution window, which was 18 ticks, to set up or adjust the hedge before the simulation fast forwarded through the rest of the month. This is the actual price chart from our RIT performance report. Pogo started at $20, dropped as low as $17.39 by the end of the quarter, which is exactly kind of the downside our hedge needed to handle. The flat black line at the 100,000 shares confirms we never touched the stock itself, only the options around it. Our first strategy was a rolling protected put. Every month we bought puts covering 100% of the position, which was 1,000 contracts, with a strike reset to that month's spot price. In January, that was a $17 strike. By February and March, Pogo had drifted down, so the strike moved to $18. Across the three rolls, we paid $37,060 in total premium. That's the cost of continuously updating our protection. The payoff came in March since Pogo settled at $17.39 below that $18 strike. That final put was exercised. It paid out $41,980, more than covering the cumulative premium. Our second strategy was a collar set up once in January and held for the full quarter. We bought a $17 put and sold a $23 call, each on 750 contracts, which covered 75% of the position, which was the most we could cover given RIT's gross options limit. The call premium was received actually covered the put premium in full, leaving a net credit of $5,917. The trade-off is that gains on those 75,000 colored shares are capped at $23, though the remaining 25,000 shares kept full upside. This chart brings both strategies together. The gray line is unhedged, red is the protected put alone, green is the color alone. These three are hypothetical comparisons. The black line is what we actually held, stock plus both hedges combined. The real settlement price of $70.39, that combined line sits flat at minus $231,090, which is exactly what the RIT report confirms as our final results. Here's the official confirmation. Our total portfolio P&L was minus $231,090 compared to the simulation average of minus $246,045. So we outperformed the average despite the stock falling nearly 13% and zero fines or limit violations across the entire quarter. This table shows what the hedge actually cost us. $31,090 in total net costs across both strategies. Note this figure excludes the $41,980 payout from the March put being exercised. This table is purely the cost of buying the insurance, not what is paid back. First question, 1 month versus 3-month options. The rolling put updates its strike every month, so protection stays close to the current price, but that costs 3 separate premiums and 3 execution windows. The collar, priced once in January, has a wider volatility range, so it's less likely to be tested, and in our case, it never paid out, but it also never cost us anything net. It's a genuine trade-off between paying for continuously updated protection versus accepting a fixed low-cost range. Second question, how does selling the call affect performance? We brought in $21,735 in premium, which is what funded the put. Since Pogo never got close to $23, the call expired worthless and we kept the full premium. But if Pogo had rallied to $28 instead, we had given up $375,000 in upside on those shares. That cap is the real cost of the collar, even though it wasn't triggered this time. Finally, protected put versus collar against our actual mandate. On pure cost, the collar wins. Near cash neutral, even a small credit. On actual protection, the put wins. He paid out $41,980 because his strike was close enough to where Pogo landed. The takeaway is that cost effective and effective protection are automatically the same thing. The right hedge depends on what you're optimizing for, not one universally correct answer.
So in conclusion, for the stock tall, it could be that baseline SOR algorithm gain more profit than the passive maker. In terms of the amount, passive maker is making over 27,000, while baseline SOR is making 62,000 profit. So this is related to the advanced selection pure basis strategy, which is practicing by the passive maker algorithm. So if we fix the algorithm to cancel the limit order instantly pivot to the market order, I believe the profit will be better than currently. And then baseline SOR gain more profit because of the tender winning in a very favorable price that I have discussed above slideshow. So in terms for the hedging, so combine protected put and call limited the loss to over 231,000 versus 246,000 simulation average. So it could be said that the mandate to manage risk cost effectively has been met. Thank you.